Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our edition of Conversations, we have the pleasure of joining with Paul Sankey, where we're just going to talk about the macro world, energy as a whole, and really kind of drill in on the North American producers as we go forward. So please, Paul, introduce yourself. Tell us what you're up to, what you're doing, and then we'll get going.
Great. Thanks, Mark. It's a pleasure to be here. And my name's Paul Sankey. This is the global headquarters of Sankey Research. I have a 1.5 bedroom apartment in Brooklyn Heights, and the half bedroom is now the global headquarters of the humble Sankey Research, which really is only eponymous, only named after me because I happen to own the domain and wanted to save money. Hopefully we'll change the staffing and maybe the name. The name's for sale, by the way, if anyone wants to buy it. We'll change the name and the staffing, more importantly, as we expand our wings, which I think, Mark, will be very likely, obviously, into the energy transition, which is so visibly occurring with BP's news yesterday.
Right.
I think, I warned you that I might go on for an hour about myself, but hopefully, I should mention, and you'll see that there's a website, obviously, and right now that registration is open. I don't say free, but at the moment it's open. In due course, hopefully, we'll charge people to get on there if there's enough interest, and that's it.
Right. Well, congratulations on starting Sankey Research in the humble abode of Brooklyn Heights. So now that we've covered that, and it came in pretty short. I think that you did a good job of shortening that up. You've always done a great job of looking at OPEC and looking at some of the movements that OPEC Plus has done, where things are going. And as it's so pivotal right now, like as you talk about jet fuel, we're seeing the demand destruction. I mean, what is your take as we start to see cuts? We saw Iraq cheating again, not really coming into where we thought they were going to be. I mean, what is your take on kind of OPEC as we go forward through the end of the year?
Well, first I should say, congrats to you on all you're doing, and secondly that, for these, as soon as we get into any kind of detail, I defer to your knowledge, absolutely.
Thank you.
Where do we start? I mean, I think that, as you know, the big problem was growth in U.S. oil supply, which was exceeding global demand growth. So that's just the big picture that we got into through 16, 17, 18, 19. 18 was a record year, 19 was a record year for U.S. production growth, and global demand was fading away. So obviously, from a simple balance point of view, that was presenting OPEC, obviously led by Saudi and very much working with Russia. That was presenting OPEC with a structural problem, particularly at a time when Saudi, since 2014, has been very determined and fairly so about its market share. So I think from the period 2010 to 2014, Saudi firmly believed that you needed US oil growth and that we would have an oil supply crisis. I think the success, and it's not any longer characterized as success on the part of US E&Ps, but really if you look at it, we've had a tech bubble in terms of technical capability and investment in US E&P companies that has been hugely successful. They've delivered a stunning technological success. And I've sat with EOG's chief technology officer and had him say that he firmly believes they're ahead of Silicon Valley, and I believe him. The entire company is run on iPhones, and it is remarkable. But what that's led to, obviously, is very high production growth, which obviously culminated in a basic imbalance that, Mark, I know you saw coming into 2020, which was very problematic. So the balance was already bad. Additionally, then, essentially COVID hit. And COVID, I mentioned just now that, the bull run in oil was driven by China. We all know that COVID hit China. So we were watching that very closely, very early. And obviously it got a whole lot worse to an unprecedented degree, although now we can debate, and I'm sure you've got some comments on this, we can debate the extent to which demand actually fell, because it very much seems that at the panic lows, demand actually never fell that far, which actually is super bullish, obviously, because the scale of economic downturn was not reflected, or you got to see how strong underlying oil demand is. So obviously we went into the meeting. One of the most interesting data points of the kind that you deal in was that the satellite trackers and the heat trackers were telling us that China had already cut Russia by pipeline. Now, one of the tough things about Russia and OPEC is that Russia delivers by pipeline. And so you can't count tankers, which many people don't believe it, but it's actually what we have to do a lot of the time to track oil around the world, because tankers are very, very big. And you can see them from satellite. And so we can actually count tankers, and we do. And, what you knew with the satellite trackers as well, to their credit, was that China, and I should credit OilX, by the way, who was giving me some of this information out of London, very, very good stuff, that the Chinese had cut Russia as we went into the March meeting. And so Russia was unwilling to cut and was arguing that they'd already cut and that COVID was unknowable in its impact, and therefore they were unwilling to cut. At that point, Saudi was also furious insofar as they were determined to maintain their market share in a weakening environment. And we had the famous no deal in March, which then had the stunning outcome, absolutely stunning, one of the biggest in OPEC's history, of a price war launched by Saudi against Russia, which obviously was at exactly the wrong moment, and which had unquestionably what will be the biggest price cut in Saudi's official selling prices. For those that don't know, you don't just pull up in a tanker to Saudi Arabia. You have to be a known customer, and you get told essentially what the price is relative to other prices. And Saudi cut to $8 below any other price. So obviously that just immediately takes $8 off any crude basically in the world. And that's exactly what happened. And we then collapsed with COVID. So there was a terrible month in there. As you know, I was calling for negative oil prices, because it was obvious that you were going to have a huge problem on the supply side relative to demand. And also, as you know, Mark, I had seen this 20 years ago when the interconnector was launched in Europe, and you had negative gas prices. It was the first time I saw a negative commodity price in a big market. And I'd always been aware of the conceptual struggle, but the physical reality that gave rise to. Last year, as you know, Permian nat gas prices were negative at the Waha hub. And so I could see that this was coming. And obviously that's what happened next. We hit tremendous lows, but then we had this construct. You might credit Donald Trump, some would, with an agreement.
I know he'll credit himself.
So that was an enormously long answer that didn't answer your question. But further to what we're seeing at the moment, obviously it becomes, as I really referenced, the extent to which demand has disappointed. I think that, we had a pretty good view of what would happen with COVID because we were using the Diamond Princess model. And the Diamond Princess model, which we were very early to highlight, really hasn't broken. There were 3,711 people on that boat. It was quarantined, but the staff were not. So very similar to a quarantine situation. And 80% of the people on that boat, who had an average age of 58, did not get COVID. Of the 20% that got it, 50% were asymptomatic, and 7 people died. So 7 out of 3,011 is basically 0.2%. And we haven't seen real evidence that the 0.2% number is wrong as a death rate, thankfully. But if you're on a cruise ship and 7 people die, I'm not minimizing this. I'm just saying that it's a 0.2% death rate, and we haven't seen something to break that. So we knew what the shape of COVID would look like. We knew that New York showed that you could flatten the curve. Obviously you did. You proved that you could. And if you remember, the strategy was flatten the curve. But right now in New York, what we're doing is we've stomped the curve. We then stamped on it with 2 feet, and now they're like firing up a steamroller and coming with a salt spreader. It's like, dude, I think, we know how to control this thing, but we also have to get back to a more normal economy and maybe actually release a little bit of COVID, arguably. But for Cuomo to be saying, come for a drink in New York if you're rich, I'll buy you one, whilst he's shutting all the bars for relatively minor infractions, is just totally stupid. Anyway, I'm going off. Back to the demand side.
It's a great setup. And when you think about COVID and as we start to prepare for back to school, and what does back to school look like, and how do you kind of continue that flattening of the curve? You bring up a great point with what we learned with COVID, and even though you have the Diamond Princess model, we learned even more in terms of treatments. And that's why you've seen people come out of the hospitals faster. You've seen the death rates fall even further, just because of where things are in terms of where we can go going forward. In case there is another increase, it won't be as disastrous as it was previously. We won't hopefully, stress that infrastructure. But just to go back
what I'd add to that is it never will be again, because as you know, in Asia, with MERS and with SARS, they were more or less prepared. Now, it's still been a human disaster, but the reality is they'd seen a pandemic before,
right,
and they weren't caught completely short. Go on.
Well, and that's why it's interesting, because when you think about wearing masks, that wasn't a thing until SARS, where once SARS happened, they changed their model where if you felt ill, if you thought you were getting sick, you actually wore the mask out of courtesy for others. And it'll be interesting to see, as the mask debate continues to rip through with the quote unquote term of Karens all over the place and others, in terms of, what does that mean? And is masks, is that it's such a divisive thing, which maybe it shouldn't be. I don't really know, but
yeah, Mark, just to add to what you're saying, I had the privilege of working for Mizuho and being in Japan with Mizuho, and knowing about masks, learning that they're not wearing the mask to protect themselves. It's a courtesy to protect others. It's actually the quote of the day on my website today. My son saying, I said, "Do you have to wear a mask in New York? Is it law?" And he said, "Dad, it's a courtesy," and I was very proud of him. But yeah, I hear you.
Yeah, so it's interesting, and just getting back to something that you had mentioned with EOG, with the apple of oil, and looking at what Saudi has done, what OPEC has done. We can get a little nerdy now and talk about quality of crude, and now we're starting to see some refiners in the U.S. start to close. Just as we have new refiners coming online in the Middle East and Asia, and a lot of them were built at a time when you still had heavy oil at a discount to light oil. And now you have this shifting paradigm, and the question is, does EOG continue to take market share? Is it something where they can continue to grow and be profitable, or is it something where you're going to have to see more bankruptcies, more pain in order to kind of achieve this balancing act coming out of the U.S., given just the refiners coming on have coking capacity, they need heavier oil, and you have this shift in the market in terms of heavy premiums versus light oil, which was always at a premium, now at either parity or a discount.
Yeah, so again, going back, what people missed about a lot of E&P analysts are not refining analysts, right? And right. That's where, as you know, and all the work you've done, you really, to understand the oil market, it's all about refining. Right. And the key thing that the E&P analysts missed in the boom, and many others missed in the boom that started in 2010, was exactly that it was all light sweet crude. Now, sorry about the dogs. And what you have is essentially a massive growth that we identified very quickly would be in light sweet crude, and the US was only importing 2 million barrels a day of light sweet crude back then. So that the substitution that people thought was an 8 million barrel a day crude import bill wasn't 8 million, it was only 2 million. And of course, that overwhelmed the market very quickly with light sweet. There's an important factor which is fairly obvious, which is that you can make a heavy refinery, although inefficiently, run light sweet, but you can't make a light sweet refinery run heavy sour, metallurgy and stuff. And so It wasn't a massive challenge to increase gas and light ends processing facilities over the last 10 years. But it's suboptimal, essentially. And yes, you're dead right. They would rather run the heavier sour crudes when it comes down to it. And as you know, there's also a major issue, which is highly relevant to OPEC, which is, firstly, Venezuelan imports are now zero. Importantly for refining, Venezuelan product imports are also zero. Exports, I should say. And, of course, we've got the declines in Mexico, all of which are the optimum crudes for the Gulf Coast refiners. Right. So... at that point, when Saudi cuts prices, that they will get picked up in the Gulf. Now, for EOG, really the only way to address that, and for all the US E&Ps that are doing the shale thing, is that you've got to get your costs down so that you're competitive with the relatively less attractive nature of your crude. And you know all about the different yields that you get, especially with the big problem in the oil market today being distillate. And, what you want to do, obviously, is optimize your output at really quite a low run rate. And to that extent, there is a challenge. But, Mark, I think that's reflected in the price very quickly. Obviously, the negative price was manipulated, we now know. But, there is, I think, going to be a very real big picture story here, which is we revert to the history of WTI at a premium to Brent. Because ultimately, you're going to shut down so much U.S. production and bankrupt the industry, exactly as you're saying. I think you're going to do that. And by the way, and when I say bankrupt the industry, I mean bankrupt a lot of the industry. I believe, I don't think I'm going to say that my suspicion is that Saudi thought that you needed the oil, as I mentioned, in the early 2010s, now thinks that they made a mistake by cutting in 2016 with Russia and essentially throwing Chesapeake a lifeline. Chesapeake just went bankrupt, so the process is underway again. But this time, I think Saudi's going to be much more circumspect about, ramping up. And I think structurally, it's not really about the US E&P industry as such. It's more about their own market share and their own agenda and their own desire to run a higher level structurally of utilization, because it's enormously expensive, as you know, to hold back spare capacity, especially if it's for the benefit of a company that's frankly not doing a very good job or shouldn't be reinvesting. So all of that said, EOG is going to be fine.
Right. No, absolutely. And it's interesting because you talk about, Exxon and some of these companies, when you look at the loss of Venezuela, we have the loss of Libya, but now we have the gains out of Guyana. You have the growth out of Brazil, and you're getting that medium sweet, which can really kind of slip into a lot of different refiners and be optimal. But you bring up a great point with distillate and the massive bills that we've seen. And then, we turn to China, back to needing to count boats. And that's really what we're doing when you look at refined product exports and imports in terms of places like South Korea, Japan, China, India, and Asia as a whole. We continue to see this massive build of distillate as companies, countries struggle to get their industrial production back up and running, shipping in terms of just the consumption of diesel and distillate as a whole. Does this distillate build create another negative cycle? Do we see additional pressure as refineries say, you know what, guys, there's nowhere to put the product. I have to cut runs further. Just as OPEC is starting to increase a little bit, you see some stickiness coming out of non-OPEC production. Do we start to see another cycle as we go through shoulder season, and if we don't have a winter to absorb some of the heating oil?
Yes. And I'm getting self-conscious that I've been speaking too much, but yes, I think that's absolutely the view. And what I'm finding here is that people are getting bullish on oil. Now, we've got to talk about the dollar because that's important.
Yes, 100%.
But fundamentally, it's such a sucker move to get bullish oil in early August. It's like, dude, really?
Absolutely.
It's like a no-brainer. I mean, every year as a sell-side analyst, I'd come out on Labor Day and say, you'll never guess what, I'm bearish. It's absolutely hilarious. And anyone who knows oil is like, no blink, Sherlock. But no, in all seriousness, one of the interesting things that I was just trying to regress this morning was a reminder of the actual data, because off the top of my head, I know that in the global financial crisis, what was remarkable was that gasoline demand barely fell in the US because of low prices. And we've been very strong on the idea that low prices would be very bullish for US gasoline demand. It's more important than unemployment. We've also got a theme on my website, which is the new 1950s, which is that there's this stunning secular change in behavior here. Which is that people, after 4 months of COVID, are buying a house somewhere else. I mean, this is not, can I rent a place? This is like, I'm buying, I'm out. And I think we've said that there's a convergence of effects here, which is essentially self-consideration in isolation in COVID, people thinking about their life. Obviously, the fact that basically what you've had here is a work from home situation that worked. So I've worked from home for a couple of days a week for years, but I was always aware as a manager that you've got to be in the office to lead, by example, and you can't expect people to commute while you don't. But of course, when everyone goes home, everyone's professional, responsible adults. It turned out none of you ever needed to go to the office at all. And, so that's been obviously a huge deal. And things like Zoom, which works so brilliantly, has a killer aspect to it, which is that for the first time, the person talking becomes the center of attention on the video. And previously, as you know, video link-ups, it never worked. It just felt weird. And, it lacked any sort of sense of a real conversation. But now, for guys like you and me who want to talk, and I mean over each other, the machine does it brilliantly. You can have 10 people on that thing. And I'm, at least smart enough to know to shut up when someone smart is talking. But the way it works is absolutely brilliant. And that's been an absolute killer app. And then the third thing, of course, which is, I don't want to sound, I don't want this to come out the wrong way, but essentially the Black Lives Matter movement the way I put it, has increased a sense of urban dysmorphia for everyone. And of course, that then contributes to the idea, as I've just mentioned, that you have mismanagement by politicians. And that then means I'm going to go into a negative tax and lifestyle quality cycle here, where they tax me more and more and more for more and more negative living environments, or whatever you want to call it, because people are so conscious of how much tax they pay already. So that's a huge shift, and I've honestly forgotten why I was telling you that.
Well, coming back to you touched on a great point with work from home, and just how does that really interact and impact the way you operate as a company. And I started in the industry back in 2006, and you always had the ability to work from home, but it was frowned upon. You were going to miss out. This isn't what you do. You miss the innovation. You miss the water cooler talk. But now, as you said, everyone's been forced to. Are we really missing the innovation? Are we really missing the water cooler talk, or things that are really kind of driving? And some of the bullishness within the oil industry is that, well, as you move out, as you go from urban to suburban and even into rural, depending on what your abilities are, you need a car. So now you get this cycle of car purchases, and everyone's like, oh no, there's going to be huge gasoline demand, but will there be? Is this really going to translate to no commute, so people are going to commute more by car, or is it just going to be a work from home where it's going to be 3 days at home, 2 days in the office? What's your take on that gasoline shift as we look at car purchases and that shift outside of the urban setting?
I think it's super bullish gasoline demand. There's no question people use. I mean, it's just a fact of the data that people in suburban and rural environments have more cars and drive more. Right. It's just a fact of life, and you're not going to take a subway. Now, I think the second phase is that the suburban life is ideally suited to an electric car. So here in Brooklyn, I can't have an electric car because I can't charge it without paying $600 to put it in $600 a month for those of you in Texas. $600 to put it in a garage with a charging port. But of course, when you've got your garage, as we all know, and you as well as anyone, an electric car is better. It's better. It's got better acceleration, less moving parts. As long as you get the battery right, you want to drive it. And by the way, suburban living, 90% of your vehicle trips are less than 10 miles. So, the idea of 400-mile range is preposterous. We do think that, it's just way beyond what anyone normally needs. Now, there's obviously an issue with if you want to drive to Texas. I've done it once and I'm not going to do it again. But, the big trips that people take, I think you can have a gasoline car. So that half your car, half the car fleet is electric. I think that's going to happen. The issue with electric cars is just arithmetic. The fact is that Tesla's selling whatever it is. I haven't got the number off the top of my head, but it's tens of thousands of cars. And there's, whatever it is, 250 million cars in the US. So basic arithmetic is that if you sold every car tomorrow as electric, it would take 16 years for the fleet to be electric. And that's the key point. Now, why is Tesla at record highs? Because the market has no certainty about today. So it's buying 30-year stocks. And, Microsoft, Amazon, Google, Tesla, for that matter, are all 30-year stocks. Oil companies, refiners trade 1 year forward earnings. So it's a very different thing that you're buying. And that's why refiners have to pay a big cash return.
And it's interesting because when you talk about cars and you start to look at the shift, the average age of a car in the US, even though you have certified pre-owned, you have all these new incentives to buy new, lease, you still have an average car fleet that's 11.2 years. So the cycle still remains slow. You still have a huge, speaking to your Texas crowd, you still have the demand for pickup trucks and, that is, and SUVs, especially in the Northeast, even though we haven't had snow or any real snow in 3 years now. So you still have this demand for, sitting high and having the ability for space. Now, in terms of, as we've seen with the stock Nikola, all these things start to move around and really going after the trucking market. Is that where you start to see some real demand pick up as we shift into providing trucks that are electric instead of the sedan, if you will?
Yeah, I haven't looked at this recently, but the line I had, and I've got to admit it was 10 years ago, is that if you want an electric tractor trailer with the range, the entire trailer has to be a battery. You tell me, what's the latest on that? Have they got the range up yet on those things? I don't know. I know that Tesla's working on one.
they've gotten the range up. The problem is the weight, where the weight of the battery essentially makes it where you have to carry a cargo of feathers and pillows in order to make it street legal. And that's something that is interesting. Like when you start talking about electric cars, I have a lot of friends, living in New York. There's a lot of Teslas, and one of the key components that they complain about is how quickly they go through tires. And you look at tires and you think about the inherent weight and the inherent strength. And, as you talk about the acceleration, you have the torque, you have the weight, which actually rips apart the tires faster. So now you're spinning tires more, but then
the tires are made of oil, right?
I last time I checked, but who knows? When you look at an electric car and you ask how much plastic, you're talking about an additional anywhere from 20 to 40%, depending on the car, of plastic in the electric car just to make it lighter, to try to offset some of that. And that's why it's an interesting conundrum in terms of, well, we need to kill the energy market, but we still need the plastic to make the electric car work, and we need the diesel to get the stuff out of the ground to then ship it to the location. So I
think that the big bear argument for oil demand for me is the whole construct is based on emerging market demand growth. Right. And I think that there's some issues, very big issues, that some of the agencies like IEA or ExxonMobil that do this work are politically sensitive. And I think that there may be a significant issue with, for example, the idea that Africa is going to have very strong economic development. It sort of depends on them getting their stuff together politically, obviously. It's very difficult. It's not the same as Northeast Asia, where you have, for example, the obvious example is China, and you could contrast it with India, where you have the difference between a centrally planned economy with, effectively, arguably a police state, and a democracy in India with a bureaucracy, and the difference in economic growth. But I think if you extend that thought, you end up with, if you see any of these long-term forecasts, you'll see that Africa, because of the population growth, and they just use an IMF GDP growth chart, I think it's actually somewhat questionable. The other aspect is that Lagos, Delhi, you name it, have absolutely chronic congestion. And so I don't know how much more car penetration you can actually get into those places, let alone electric cars. One thing that really interests me, obviously, is autonomous driving. And that, of course, isn't necessarily electric. I mean, what I would really like is an autonomous car because, guess what? I sit in traffic jams too, although not recently, thankfully. But, there's no reason, to my knowledge, why you couldn't have an autonomous petrol car,
It's a great point that you bring up when you think about India, because everyone always likes to talk about, it's going to be Indian growth. It's like, well, have you been to India? Have you seen, like, if you think an electric car, have you seen the grid where and then you look at Africa, and this is where I always have interesting debates when people are like, oh, well, Africa is going to grow. It's like, well, think about the generational cycles where you continue to see dictator after dictator, and then, they go through these cycles and you're not really seeing any real pickup. But at the same time, speaking to India and China, and you look at the growth, even during the COVID downturn, gasoline, diesel demand fell anywhere upwards to 40%, but yet LPG demand never really went down. You had a small decrease of, let's call it 5 to 10% from obvious reasons. But now, back to your point on COVID, where people are changing spending patterns, people are moving to suburban. What do? You cook more, you consume gas. So is it something where I look at it where oil demand is going to see pain, but you could see a pickup in naphtha, natural gas, in terms of, back to the point on Tesla and electric cars, naphtha and NGLs, great for plastics. You have LPG, great for moving around the country, great for heating. It's a lot of benefits. So is it something where oil remains relatively stagnant, but we see some growth, which maybe benefits the U.S. more than people are considering, because NGLs and naphtha, I mean, we have that in spades.
I mean, it's a great point. In fact, it's funny you mention it, because I was only looking at the DOE data and marveling at the whole LPG export thing. You can't see COVID in the data. There's no COVID in the LPG exports.
It's really flat. It's like a little like dip, and then it's right back to growth.
Yeah, and it's, and generally oil exports, exactly to your final point, the oil exports from the US have stunned me, that you've retained that competitivity. Because what's fascinating about markets like this is, obviously, you test the market. As equity analysts, one of the things we look at, obviously, is how much money did this thing make during a COVID quarter? Because I'm sure that's going to be the worst quarter. Exactly for the reason that you earlier highlighted, which is that you came into this COVID unprepared in the US. It's not going to happen to the same extent ever again, thankfully. It'll have to be something very different, because we've seen one of these already now. Whereas previously, as in fact others have referenced, notably the president in the Axios interview the other night, this hasn't happened since 1917-18, which obviously is outside of a generational memory. So yeah, absolutely. Now, I used to live in Africa, and the issue is exactly, I think you're dead right here, is that there's tremendous. It wasn't that gasoline was too expensive, it's that there was no gasoline. I think, one of my lines, and I really do admire what Greta has done, but she's got to go to India and China. She can't come out of Sweden and come and lecture people in California. You're missing really a big part of the plot here. And, to understand the challenges of people in extreme poverty, particularly in the case of India, but also in China, and the issues of emissions for people who are trying to struggle to get food on the table, it's really quite patronizing to lecture. Not that she's, I'm not being very specifically critical of her, but I do think you have to have her come in and think harder about what's going on in the biggest growth markets in the world, of which, of course, Africa is one of them. But by the way, you make an excellent point, which is further to light sweet crude as well, about LPG exports and all the other stuff. Absolutely.
Well, and when you bring up a good point when you start talking about emerging markets in Africa, it's food security, and this problem of food is like, well, am I going to spend money on gasoline, or am I going to feed my family?
Yeah.
And you're starting to see you have to make a choice.
Yeah, I mean, it's unfortunate. One of the good ones is a scooter does 220 miles to the gallon, right?
Yeah.
So that, a lot of people in Africa are walking. And so there is a latent demand there. There's no question. It's just that the efficiency gains, I believe, in the OECD are surely going to be a very big counter. I think that 100 million barrel a day market, will we go to 110? I don't know. What's your view? Do you think you do 110 million barrels a day?
So I think we can get to 110, but not on the shoulders of oil, but on the shoulders of LPG and naphtha demand. So and that's where I always get critical when people talk about it. It's like, well, oil demand. It's like, well, let's break this up. Like, let's look at what that 100 million is really composed of. Right. Because to call it just oil demand is, I think you have to get a bit more specific, especially in this market when we start talking about light sweet crude, the growth of the U.S., where we sit in, and then the growth of chemical facilities in terms of everything from ethane on down. Or up, if you want to think about the chain.
Yeah, I mean, here's another one for you to think about, which I always say, which is, look, what we really need globally is solar power in a liquid, energy-dense form that's abundant, cheap to produce, globally available, and obviously I'm talking about oil. And then additionally, something that has all these component parts, because, the original substitution of whale oil into oil was kerosene for lighting. And, I think it's a great point. I think it's a fascinating point.
Well, and it's interesting when you talk about China and you look at, now you have India, which has 13 of the 15 most polluted cities in the world. And it used to be China had that crown. Yeah. And they've helped to reduce that by really just going after coal. I mean, just taking coal and switching it to propane, natural gas, and there's a lot of low-hanging fruit. The problem is, if Greta walked into China and started saying things, I'd like to see how Xi really would take that kind of criticism. But
this is the issue. This is the issue with ESG. This is the issue with ESG. When I wrote the Greta effect note, which I wrote in January about the ESG effect, I called it the Greta effect. The opening slide was that the world's biggest polluter is Coca-Cola, because if you count what's on a beach, Coca-Cola wins by a mile, and I think it's 6 of the 7 most polluted rivers in the world are all most plastic polluting rivers in the world are in Asia, if I'm not wrong. I think it might be 5 of the most polluted. So, and the point I was actually making is that this ESG thing is so extraordinarily complicated in terms of what it comprises, because it essentially comprises everything from Black Lives Matter to, LPG. And one of the things is, can Apple really keep making things in China? How's Tesla going to be perceived in China when you don't have the human rights?
Right. And that's when we start to cycle out and you start to look at the movements of supply chains and how things really start to shift. And that's where, as we move out of China, and look at retail, right? You look at the creation of polyester on down to the consumption and usage of clothes. We moved out of China 10 years ago as prices went up. We moved into Indonesia, Malaysia, India, Pakistan. And now you're starting to see the more expensive things to move, the chips, the things that they really suck juice from the grid, and you need to build the grid. But how do you make the grid sustainable? So if you go to Vietnam, you have to build a grid from from scratch. Are you going to do that with a coal-fired plant or a natural gas plant? Especially given where LNG is pricing, and that kind of comes back down to, when people talk about the growth, everyone assumes you start from the base. Well, it's like, well, if there's better technology available, do you just start at the better technology, then grow to the higher level? So again, that's not diesel demand, though you could say the ships are going to be more efficient, so that's going to be less diesel and more natural gas consumption as you put in some natural gas short cycle gas turbines. But when we look at kind of the future, and we've seen the pressure, like as we mentioned at the very beginning, in terms of the U.S. and some of this pressure, and half the industry, 3/4 of the industry going bankrupt. What is this? Where do you see consolidation? Where are you kind of seeing where's the pressure? Like, is Exxon going to get bigger? Or is it something where we're going to get new mini majors? Like, does Continental buy CVI and because it makes sense, or does it make sense? Like, what is the shape or the shift that we're going to see in the U.S.?
Yeah, well, first let me second your point about natural gas. That's clearly the fuel of the future. And, just two things I'd add. One is that you can't run a grid 100% on solar and wind, as you well know. You have to have a stabilizing factor. And if you want an object lesson in how not to do this, of all places, the Germans completely screwed it up by shutting all their nuclear. If you assume you're not going to shut nuclear, or rather build nuclear, it's going to have to be natural gas that stabilizes and provides enough electricity for year-round use. So natural gas looks amazing. The second thing I'd add is we mentioned the testing of the down cycle with COVID. Natural gas emerged in the US as, firstly, US electricity demand held up, presumably because everyone was at home. But secondly, natural gas emerged as very clearly a baseload power fuel. So that's a very significant moment in power generation history in the US for sure, and is a very significant fact globally. How do the majors deal with it? Well, first of all, you've got BP, sensational news yesterday with them essentially saying, I thought, quite a few renewables type bells and whistles. We're going to be 10% of hydrogen markets, which is like saying, I'm going to be 10% of nothing. But also saying we're going to reduce our production by 40%. Oil and gas production was like, whoa, that is a very big number from one of the biggest oil producers in the world. Very questionable for what they do in Russia. And of course, then they're not going to explore new basins is also huge, just because BP was the exploration play amongst the big oils. So that's also stunning. Of course, the unconventional revolution in the US has arguably meant that you don't need to explore anymore. Yesterday, I wrote, Mark, in the morning Sankey, which people can sign up for, about how the BP announcement was extraordinarily bullish for oil. Essentially, shareholders don't want to support the stock doing what it's doing, so they're going to walk away. And they halved the dividend. The stock went up 6%, more because they're going to try and address the energy future. But as people have highlighted, not least me, they've got a poor track record of generating returns in oil and gas. We can assume that as soon as the big oils walk away from oil and gas returns are going to be outstanding. It's just the way it
Great
works.
at timing.
And as they run to the other side of the ship and all start investing in electricity, guess what's going to have absolutely horrible returns? And I tell you one reason why. If they all make renewable electricity projects, and you can only have 20% of the grid from renewable, guess what's going to be oversupplied next? And the history here is horrific for just getting it wrong every single time, because they all do the same thing at the same time. But interestingly, Chevron and Exxon arguably are not. I think it's a problem for Exxon because they're not leading on ESG. In fact, they have a public image of the worst, public enemy number one almost. They might as well be a tobacco stock in the grand scheme of things. But how does it play out? I think that we're agreed that the outlook here is actually bearish for oil. I think the low will be February 21. The canary, it's more than the canary. It's whatever a big bird is in the coal mine, is refining profitability. Margins are horrible. You either need a demand rally, which you don't get at the end of summer, or you've got to shut down refineries. You shut down refineries, crude demand is weak. At the moment, there's an ugly contest in currencies and the dollar's losing all of a sudden. That will make oil look higher than it really is on a fundamental basis, which is exactly what's happened over the past few weeks, is that oil has got to a high since COVID, I think entirely on the dollar weakening.
Okay.
There's a very simple reason for your viewers, which is that 90% of world's oil trade is in dollars. And so if the dollar weakens for whatever reason, if it's this latest just blizzard of dollars that the US is just crazily pumping into the market, the dollar's going to go down. So US real rates are below Japan now. And, you wouldn't have thought that there's a way, any way that would have happened if you'd asked me 5 years ago, how would US real rates? Actually, 5 years is not true. If you'd asked me 10 years ago, US real rates below Japan is insane, and that's very weakening for the dollar. So we're bearish on crude because of bearish refining. That means you've got a lot more pain to come in E&P. And so obviously your long defensive names, like something like a FANG, which is a very, very good, very low cost player in the Permian, which has a very hedged book. When the market turns, and by the way, we also have a disclaimer as oil analysts that Ed Wolf back when, as my boss came to me and said, "Paul, how are you always so wrong on oil?" And I said to him, "I'm less wrong, man. I'm less wrong." But the fact is, we could be hopelessly wrong here, obviously. But, we've tested oil in a lot of ways, as you know, over the last year, especially the attack on Saudi, which is almost forgotten, funnily enough, was about the most extreme test, lose 7 million barrels a day you could have had. And we didn't get any significant upside in oil from that. It means that there's fundamentally enough oil right now. The balancing item is US E&P, and you still have more to balance, in my view. And so because you've got spare capacity still on boats, you've still got inventory on boats. Until you've got the oil off the boats, you can't be bullish fundamentally on oil. And then and especially not going into winter. I do have a pet theory, which is kind of low grade, that there's going to be a freezing winter, and needless to say, lots of hurricanes because it's 2020. Actually, a hurricane hit my backyard the other day. So something like a FANG, which is very defensive, is by the way, Pioneer came out yesterday with a really good framework, right in line with our Renaissance thesis of how these E&Ps should address the market hatred of them, which is you've got to pay a double-digit sustained cash return to shareholders, and it's very simple why. If you pay 10% yield, which is in my pocket yield back to me, A, I'm attracted to the stock if I believe it's going to last. B, over 10 years, all my capital is returned. So I put $100 for one share, $102, I believe today, Pioneer PXD. Basically what he's telling you is he's going to pay you 10% a year. That means by year 10, I have a zero basis. And then I have an option on oil. That's an incontrovertibly good investment. And I believe that company. So that's exciting. And then there's other stuff where, multi-basin stuff, we don't need to be specific and rude, but, there's stuff which is multi-basin or short inventory. If you look at the buck, and I'm sure you'll start ranting now, Mark, it's very difficult to see. If you sit below zero decline Canada and lowest cost, biggest resource Permian, it's very hard to see how that fits as really as a big region for some time until, funnily enough, WTI goes to a premium to Brent and starts asking for the oil, and I don't think that's anytime soon.
Well, it's interesting when you start talking about Pioneer and you look at whether or not you like Sheffield, don't like Sheffield, they have access to the ports. And when you have access to the ports,
do you think I'd be dumb enough to say I don't like Scott Sheffield? Nah, he's great.
I can say whether or not it's regardless. It's the fact that they have access to the ports, which just means that if you think about when we first started exporting crude, Conoco was first, PXD was second in terms of first cargo, second cargo. So you have that direct line, which is that access where you don't really. Given you have refiners that are going to consume, but you have optionality. That optionality is something where you have direct lines, you have the pipe, you have the availability, and you can help kind of manage that pricing that a lot of others just don't have. And that's where when we start getting into winners, losers, it really comes down to what does your rock look like? What is your firm, and what is your takeaway? And where does it point to? Are you pointing to some tank in Cushing, or are you pointing to a dock on the Houston Ship Channel? And that's a huge difference in premium.
Well, I mean, let me be clear. I like Scott a lot. I love his position as a mouthpiece. It's just great when people talk and say, I was watching believe it or not, I've got to say, Real Housewives of Beverly Hills for the first time in many, many years yesterday. And she was saying, you've got to just, you've got to be true to your feelings. And, it's just great when somebody is true. Scott says it as he sees it, and I really appreciate that.
Yeah.
On the question from an equity strategy point of view isn't who's best in terms of, because obviously you want to own the best. The problem is the leverage, right? So arguably at times you want to own the worst. And there's two types of leverage. Just the stuff that has high break even, which as you referenced is not really, it's just not good stuff, but you only need it if the oil price is at $100 a barrel. And then, of course, there's financial leverage, so there's two types of leverage. If you've got too much debt, and some companies have both.
Right.
And there's times, when you buy the worst, out there, precisely because at the margin they're the biggest beneficiary. That's not this tape for me. For me, this tape is, you can start thinking about adding to really good core positions of really good stuff. And that Permian core stuff is attractive to me. I'm really uncertain about Canadian heavy oil sands just because it reads so bad ESG wise. As good as Suncor's is really absolutely as good as any company there is on ESG, but it's tar sands, and it's just very hard to think whether or not these are really going to pass muster. I think Permian can pull it off. The other big idea, arguably, which I think Suncor does check on, is do you now want to buy the best rates of improvement in ESG? Because if a BP is the best, most improving story in ESG, shouldn't you be supporting it? That's a real argument. And so, you could argue that the rate of change in Tesla, if they get sort of found out about China or whatever, or cradle to grave that you've referenced, is a Tesla really more environmentally friendly? It's highly debatable. It's very silly just to look at the operating fuel and say this is less environmentally damaging. Is the rate of change at Tesla negative, and the rate of change at, let's say, Exxon, to give you a great example, is the rate of change there positive? That's how stock markets work, right? We're not. Harry Hindsight's the best trader in the market. We've got to try and look forward here, and that's where the market values. The market values the future, which is why it's buying, as I said, 30-year stocks, because it has no certainty. The oils can't go down forever, and Microsoft can't go up forever. At some point, there's going to be a megaturn. I think it's now, by the way. I absolutely think it's now. It's just I don't like oil into February 21.
Well, it just, we're running out of time. So last question in terms of where we're going. You brought up a great point where the 10-year, if you think about real rates, we're now negative 150 basis points. You have inflation fears, which historically has sent gold, silver, crude higher as the dollar falls. But the question is now, the fundamentals start to outweigh and you start to see some of the crude come under pressure. But again, those would be short-term issues as you have these inflation fears. And as we look at grid sustainability, because again, people don't die when it's 65 and sunny. They die when it's negative 20 and your power goes out, or it's 110 degrees and you stress the grid to the point that it pops. And you need that sustainability. So you need that balance. And as we go forward, and then we consider inflation, we consider where rates are, where borrowing is, where do the energy equities benefit? As you talk about those 30-year stocks, like what are we looking at in terms of energy, and who is the 30-year stock? Is there a 30-year stock within the energy that kind of gets it right, and this is where we want to look at? Or is it something where you just have to kind of wait for your timing to really kind of get into this market?
I think that everyone on Wall Street, everyone in the US more or less is looking at an all-time high stock market and looking at the economy and going, what the hell's going on here? And it's obviously about a dollar blizzard. And, it's very conventional that dollar blizzards will lead to inflation. And my view is that you don't get inflation without oil going up. So that's actually a huge second point that we're making. Firstly, the companies are getting their strategy right. Absolutely. We referenced Pioneer leading. And secondly, the fact is that until the inflation is going to come with rising oil prices, and it's going to crush growth stocks, because obviously if you're valuing a stock on 2030 at 200 times in some cases, if you're then going to cut the dollar in half with inflation as well over that period, it's actually at 400 or 500 times. And what you have to buy is hard assets. And you can buy vintage Ferraris in your case, Mark, but you've got to buy something with a limited stock. Don't buy a new Ferrari because they make a lot of them. Make something, buy something real that's going to have tangible value in the future. And one of the things that obviously is highly inflatable, let's say, is oil. People obviously buy gold. It's got no real functional use, but a little factoid that you'll enjoy, my friend. Did you know that a Model T Ford cost the same as a Toyota Camry when measured in ounces of gold? What will happen is there'll be a big rotation into inflation as oil goes up, right? So until you get the oil going up, there's no inflation. But believe me, I said yesterday in my note that the market's going to be yelling for more oil supply. And what you've done to these oils by bullying them, even though they did their very best technologically and succeeded, is they're not going to trust you. They're not going to reinvest very quickly. So the next upcycle is going to be an absolute doozy. It's just that with this awful COVID stuff and whatever, you don't look, as you know, the first principle is demand. Demand is horrible. So is it underlying horrible? Not at all. It's very strong. If you think about US gasoline demand only down 8% in this tape in terms of the economy. But the reality is this economy is really not in good shape. And until we turn, oil's going to struggle. But when we turn, it's going to be really an epic trade. Do you want to time it? That's my job. We try and get it perfectly. As I say, I've never been wrong. It's just my timing is sometimes off. And obviously the hard thing is getting the timing right. But I just don't think, and it's as simple as seasonal, that you go loading in August with the market at a record high, even if oil's at a record low relative.
Right. No, I agree. Well, Paul, thank you for the time. It was an absolute pleasure. Do you have anything that you want to leave us with?
I can't say how highly I think of your work, mate. It's outstanding stuff, and I really appreciate what you do.
No, I've always appreciated our relationship. So thank you again for joining us. Again, thank you, Paul, for joining. You can find him at Sankey Research. You'll have the URL attached. And again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.
Thanks, guys.